What is going on, investors? Hopefully you guys are doing well out there. Got an interesting video for you today. Not just a stock analysis, but almost like a merger analysis. This is one that we haven't actually covered here on the channel before. So we have Teladoc here. A well-known company, has been on absolute fire over the last year. This stock has gone from a $54 stock all the way up to $253 in the last 52 weeks. Now, what was interesting is they decided to merge with another high-flying hot stock as well. This Livongo Health Company, ticker symbol LVGO. This stock has gone from a $15 stock all the way up to $150. Now, what's interesting is these stocks, both of them actually sold off pretty rapidly when this deal was announced. So it's interesting. These stocks had a ton of momentum behind them, had a ton of shareholder love, and then all of a sudden the deal was announced and these stocks sold off. So let's jump into the reports here. We'll take a look at the financials. We'll take a look at both companies and then kind of take a look at a combined company that they gave on Teladoc here. They kind of gave you an overview of the combined company, and then maybe we'll jump into the stock chart. We'll see if we can pick a range here. We see the stock was in an uptrend. It broke this uptrend, and we're kind of trading down here. So that's kind of interesting. But if you look at this MACD, woo, that's bottomed out. So there could be some value here. Let's get on with it. So we got TDoc. It's merging with this company here. The details of the merger. So if you have shares of LVGO, you're going to get 0.592 of Teladoc shares, and then you're also going to get $11.33 per share, representing a total transaction of about $18.5 billion. Now, what's interesting is today, and these numbers may not be 100% accurate, but we've got about $11.5 billion market cap on this company. And I saw some commentary that, look, this stock went from 15 to 150, and they didn't get, I mean, it's a pretty hefty premium, in my opinion, going from $11 billion company up to 18, but at the time of the announcement, this company was a lot higher. In fact, it was much higher than this. And so it wasn't a huge premium that Teladoc had to pay for this stock that has been on an absolute tear. And so let's take a look at Livongo's financials and see, well, what did Teladoc see and what is the market telling us with this type of merger? Now we'll see, let's just take the most 3 months ended here. We got 1920. We also have 6 month ended 1920, but I want to focus on the most recent quarter because it's really interesting. So you see, boom, our revenues are absolutely sky high in this stock. Investors must be super excited about this. And I can totally see why shares were flying high, is because we went from 40 million, basically 41 million in sales, all the way up to 92 million. That's absolutely explosive growth. Even more impressive than that is probably these gross profit numbers. Take a look at this. We went from 29 million in gross profit all the way up to 70. These are phenomenal margins. People ask me all the time, what do I look for in a stock? Where do I, how do I pick stocks? I love stocks. This is not always the case. You can't always find us in stocks, but I love stocks like this that are growing the top line quickly and then have high gross margins. You want proof that other shareholders like this? Look at this stock chart, okay? This stock was on absolute fire. And so this to me is the number one thing, at least in the current market that we have now. Investors really reward high growth rate on the top line, high gross margin. Combine that with a company and you're typically going to see a stock that's absolutely ripping to the upside, which this stock is. Now, even more interesting than that, this LVGO stock seemed to be at a turning point, because take a look at these operating expenses. We had 70 million in operating expenses versus 70 million in gross profit. That was a break even. So essentially we lost a little bit of money, but it's basically a rounding error what they lost. Take a look at the previous period. We lost 13 million. And so this is a company that totally turned the corner. We see for a 6 month basis, we lost 28 versus 7. So this company was basically right at the tipping point of breaking even. I think shareholders were really excited about that, bidding this stock up, expecting profits to come. So depending on how you look at it, you could be a disappointed LVGO stockholder, but maybe you weren't in either of these companies and you say, hey, what's up with this new company that Teladoc just acquired? Well, look at this. They are growing their top line quickly. I don't know if that will necessarily continue, but I can imagine this top line, you'll still see growth combined with high gross margins. This is a winning combination, in my opinion. And so, and the premium that they paid for this stock, not necessarily that high. And so I actually, on the first blush of looking at these financials, I really like what I see. Now let's jump over to Teladoc and check out their revenues. We went from 130 to 241. This is quarter end 1920. Both these companies basically just recently reported earnings just in the last week or so. Now, Teladoc's got some cost of revenue, and they don't break it out from a gross profit perspective. They get down here to total operating expenses. We have 248. Okay, that's versus the 241 that we made. So we lost about 7 million. I see these are in thousands. So we lost 7 million on this company. Now that compares extraordinarily, and that's like 3 times better than the previous period where we lost 22. So this is a company that's seen a little bit of efficiencies with their costs combined with increasing that top line. From a 6-month basis, you see we lost 28 versus 44. So Teladoc's not quite as close to turning the corner, but my guess is they're only maybe a quarter or two away from either breaking even or turning a small profit. So you are getting a combined entity that is basically at the turning point. And so if you believe that these companies are going to keep growing this top line revenue, which a lot of people around kind of the telehealth and kind of maybe new way to do telehealth, and obviously with the virus and things like that, there's a lot of that going on, and people can consider that something that will continue. If you think both of these companies, maybe not consider this electric top line growth, but if it will continue to a reasonable degree on both companies, I think you're going to see a bottom line begin to turn positive for the combined companies, because you're also going to see synergies from the sales and marketing, the technology, the advertising. These companies don't necessarily need 2 of every employee. There might be some synergies there. In fact, they talk about that in the press releases and things like that, that they'll probably have some synergies, including some sales and cost synergies that will definitely appear over the next year or two. It will take some time to materialize, but eventually you will have some cost synergies here as well. So the combined company for the trailing 12 months, anytime you see TTM, it means trailing 12 months. So they take like right now, basically June 30th, and walk it back 12 months as well. So we've got a combined company worth close to $1 billion in revenue. Year-over-year growth is right in that 50% range. So, maybe give them credit next year for 40% or 35%, and you can start to do kind of back of the napkin math on the type of valuation and the stock price that you might be willing to pay here. Gross margins look sensational. Obviously, this company had sensational gross margin. Teladoc was nothing to sneeze at as well. We have some cash on the balance sheet, but also some debt being carried over. But when they're growing revenue this quickly, and probably the combined entity will likely probably raise some money or be able to raise money if they need to. Now, do you want to buy shares of Teladoc? Maybe you do. Maybe you want to buy shares of LVGO. Maybe you do. Okay, what I see here is kind of a knee-jerk reaction by shareholders. We see this stock, I think, probably made close to a bottom here. It has recovered a little bit. I think this stock trades in a little bit of a range here. I don't necessarily see it coming all the way back up here before the merger is closed. I believe it's going to be closed within the next few months. And so I think you've got some time to jump on this train if you want to jump on it. Again, I see 2 companies growing their top line very rapidly, 2 companies with high gross margins, and 2 companies that were very close, if not right at the turning point of profitability. So this is a very, very interesting combination for me. You're paying a little bit of a premium from a price to sales basis. Obviously, you don't have any earnings, so you have to look past the PE ratio. You're not getting a dividend and that type of thing. So you want to keep all those things in mind. But this was 2 different companies on an absolute freight train of a tear over the last year. I mean, both these stocks were going to the moon, and then all of a sudden they decide to merge, and they've sold off, rather considerably, actually. For these stocks to sell off, I don't think anybody was anticipating it. So you're getting a combined company It's an interesting combination. They don't necessarily compete or overlap too much with current customers. They'll have some cost synergies that will appear over the next few years. I think this is an interesting one. If you don't have if you're like me, you don't have a lot of exposure to kind of healthcare and certainly like kind of new tech healthcare, this is definitely one I'm kind of interested in, one I will be definitely monitoring as well. I think if you want to allocate this, if you have $1,000 portfolio, obviously one share at 190 is going to be close to 20% of your portfolio. So you need to be a little careful with your allocation. If you got a smaller portfolio, you got a bigger portfolio, I'll let you weight it based on, how well you're diversified within the healthcare space and the tech space and the other spaces out there. So there we go. Hopefully you guys like this one. A little bit different. So TDOC is going to become the combined entity. If you buy shares of LVGO, you will get the 0.592 of shares of Teladoc plus $11.33 per share. So things you want to think about if you own LVGO or you go and just buy LVGO outright is you might have some tax implications. Okay, I'm not a tax attorney and I have somebody else handle that for me, but that's one thing that you want to think about. If you buy this company and then you get this $11.33 per share, if there's fractional shares, you might get cashed out of those. So you might have some tax implications. So that's just something you want to think about, although the stock will probably not move around too much. So it might, depending on your position size, might not be too bad of a tax burden, but you want to factor that in. Yes, you might get a small discount by buying these shares and then backdoor your way into TDOC, but you got to factor in what Uncle Sam might take from the transaction as well. So that's something you want to think about, and I would encourage you to ask your tax professional if you have any questions about that. So there we go. That was Teladoc. That was LVGO. Hopefully you guys enjoyed it. We'll be back again very soon with another video. Good luck with your investments.